Hello everybody, welcome to tonight's meetup group, brought to you by the Affinity Trading Institute. And just going to say a few words about our little meetup group here. We run one of the larger trading educational meetup groups here in New York City. And every month we have different guest speakers. Tonight we're very fortunate to have Tim Kelleher, who trades with Quasar Trading and the Affinity Trading Institute. He's going to be talking to you tonight about the essentials intro, pre and post-market intraday trading. One of the things I'd like to say is that one of the things that you should do as a potential trader is to proceed with learning how to trade with caution and in a prudent way and with discretionary capital. If you are going to try to learn how to prop trade, you should go about it by getting licensed, Series 56 license first, and getting sponsorship from a professional trading broker-dealer. One of our sponsors is Quasar Trading, and we could talk to you about some of the ways that you could work with Affinity Trading Institute and Quasar to become a professional trader. And in terms of discretionary capital, one of the benefits of going to a professional trading firm is you don't have to start up with quite so much capital. I am a registered representative with Legend Securities, and as a registered representative with Legend Securities, if you are to open up a customer day trading account, you have to open up with $25,000 or more to get 4-to-1 leverage in order to be able to day trade as a customer. However, if you go and get your license as a professional trader, you could start trading with as little as a few $1,000s, and the firm backing you, or a trading group backing you, to providing you some capital, some risk capital, and potentially lots of additional leverage or buying power so that you can trade and try to make a living from trading. So if you have any further questions or need further information, you could email me at Mike@Affinity Trading, or you could email Tim at tim@affinitytrading.com, and he's going to be your presenter. So without any further ado, I'm going to ask a good friend, Tim Kelleher, to step up and tell us some of the essentials that need to be learned in order to proceed with trading successfully and consistently profitably. So everybody, let's put your hands together for Tim Kelleher.
Okay, afternoon everybody. Thanks for showing up here at Legend while we're giving our monthly meetup. This here on the left here is a logo for Juggernaut Trading, which was a competitor for Affinity Trading Group. About 9 months back, consolidated my company with Mike's group. He had a little bit of a bigger company there, and we were able to do more things together. So we have a full program here where we provide educational services and basically all the introductory information you need to get started in proprietary trading, which pretty much is what everybody is here for and showing an interest in. I've managed large brokerage firms. I've built brokerage firms. I've built educational companies similar to Affinity, and probably have trained close to about 400 to 500 traders since 2006, since I've been doing this professionally. And I'm just going to jump ahead here real quick and move along these slides. And for the YouTube recording here, I do apologize that you can't see these slides as good due to the lighting. This is just a quick disclaimer. And here's some of the course topics. I'm going to talk about my background because it relates to trading and the evolution of trading and how things have moved along. I'm going to talk about my different styles of trading. There's all different kinds of styles of trading. When you're talking about the type of trading we're doing, which is one of 3 styles, we're doing intraday trading here as opposed to swing trading and fundamental trading or investing. And they all carry different kinds of risk. Right now, the least riskiest type of trading is the type of trading that we're doing, intraday trading, because you don't typically expose yourself to any kind of overnight risk. Right? We're in a very unstable environment in the world with politics, fiscal cliff talks, you know, the debt ceiling going on, you have problems in Europe, currencies, you have war, all kinds of things. So anything could happen overnight. So there's a different level of risk when you're carrying positions overnight. We'll talk about some of the realistic time frames and goals. This is an important topic for everybody that's here. Determining if this is suitable for you, designing a realistic game plan, the probation period that's required, all right, and I'll talk about some things that I do on a daily basis with my pre-market checklist. All right, so let me just skip a couple of slides here, if I can. And I just want to go up to my background. And I know it's kind of hard to see, but I've basically been in this business since 1992. All right, I worked for Reuters, Instinet. Instinet was the third market back in the day. There was the New York Stock Exchange, there was the Amex, NASDAQ, and then there was one electronic trading network that everybody used, and it was Instinet. All right, Instinet was a very, very big company, and I was privy to go on every single major institution's desk. Every major broker-dealer was one of my clients. I traveled the country. I've been on the desk of all these firms, all these white shoe firms. I managed all their clients out of the Southeast for the tail end of my career with them from 95 to 97. And ultimately, I left the business and got into trading professionally in 1997. This is a key year in trading, right? In 96, 97, that's when the advent of the ECN came along, right? ECNs are a vehicle, I don't know. Is there anybody in here who's experienced traders? Everybody, just let me do a quick survey. You guys retail? Anybody prop? Professional learning? All right, so just trying to get an idea of your background. So if you are a little bit more experienced, maybe you could get something out of this, and if it's redundant, just forgive me. But in 96 is when they started the advent of ECNs. Archipelago, Instinet, INET. INET became NASDAQ, which it is now. It merged with Island. Back then it used to be called Island. And those were the major ECNs. And that's basically what brought Wall Street to Main Street. That's what made it so everybody could trade the way we trade right now, electronically. Before that, you needed, you know, an account with a broker. You had to call up a broker who would in turn call up a trader on the floor, and then they would trade with the specialist. Now, you know, you have all different types of trading where you can trade electronically. So that was a big year. And also these years were the years when we had the internet bubble explosion. So those were really good years. Those were the best years of my career, and it was right when I first started trading. You know, I had a lot of six-figure months there. I had a couple of years where I made seven figures, and those were really good years. So that's something important to talk about, because I've seen the evolution of the market and how things have traded, and also that's what crushed the New York Stock Exchange, because their business got diluted. Now on my trading platform, I have 30 different routes I could send my orders out to, in addition to the New York Stock Exchange. Years ago, you just had the New York Stock Exchange, Amex, and NASDAQ. Now you have all these different ECNs, all these different exchange routes. And the other thing that killed the stock exchange, of course, was in 1999, 2000, they changed from trading in fractions to decimalization, which really crushed the margins. You know, years ago, you used to have at least an eighth to a quarter point spread. Now you have penny spreads, right? So an eighth of a dollar is 12 cents, you know, so it crushed the margins by 12 on the spread. So that's what really, really, you know, diluted the business and made it more of an electronic venue. And then after that, around 2006, I started with an educational company, and then ended up going out and founding my own company, Broad Street Trading, Juggernaut Trading, and then ultimately I ended up coming over here with Legend and Affinity, and here I am now. All right, so the time's gone by pretty quick, but I love the game. I love trading. It's the greatest job in the world if you guys can make it work. It's a lot of fun, and the years have gone by really quick, because, you know, I jump out of bed like a kid on Christmas morning every day. I really do. I love what I do. It's a lot of fun. It's not the type of job where, I mean, I've been here at 7:15 at night. I've been here since 8 o'clock, before 8 o'clock this morning, and the day went by like that. So it's very exciting. It's the greatest business in the world if you can make it work. All right, and it's not brain surgery. It's not the hardest thing. You just need a couple of key components, and we're going to discuss that now and give a quick basic overview. All right, so let me go back a little bit. Enough about me, but I just wanted to talk about my background a little bit and how it's evolved with the markets. My trading style. There's all different types of trading styles out there. There's certain styles that involve high risk. There's certain styles that involve lower risk. And a lot of it has to do with the times of day that you trade. All right? If you look at a chart on the S&P today, and I just gave another seminar before this one where I was broadcasting from my trading platform, but if you look at it, the overall trend of the market today was down, which was nice, but the first 15 minutes, we went from lows to highs to lows to highs. There was a lot of static. All right, so that particular time of day is very high risk, very high reward, as opposed to like when things settle around 9:45 to 10:15 or 9:30. And I'm going to jump ahead to a different slide here, and here it is. This particular slide right here, 7 a.m. to 8 a.m., that's pre-market. 8 o'clock to 8:30, that's when mom and pop online trading companies like E-Trade, Ameritrade, Charles Schwab start coming online. Our Tachyon platform starts at 6 o'clock. 9:30 to 9:45 is typically a red zone. That's a very high risk time to trade. All right, so a good rule of thumb, if you're a beginner trader and you don't have a lot of equity to trade with and you don't want to take a lot of risk, is to wait until things settle and you get a trend like you did today, where you had a series of lower highs, lower lows, and things started trending, and that set up right at 9:45. If you look at a chart on the S&P today, right around at 10 o'clock, we made a new low and we started a nice downtrend that went all the way until lunch. And if you notice, lunch is not a set time. Today lunch started at 11:45. All right, that's when we stopped going down, we broke our downtrend line, and we shifted to the upside. We still were down on the day, but we were well off our lows, and that trend was ended after 2 hours of selling. So lunch was dictated by that. And this morning in the online trading room where I broadcast, and then Rob Shapiro, who's the primary broadcaster for Affinity, their day was in. They had a great day this morning. I had a lot of my traders that are beginner traders make upwards of $200-300 per trade, and they were done. They were done by 10:30, 11 o'clock. So real nice day for trading this morning during those time zones. Then there's lunch. Then 2 o'clock, typically the market starts setting up for where it's going to make its final move of the day. Today, it never went back and retested lows. It never retested highs. So today was a day where if you made money in the morning, it was good to just kind of sit back and not really trade and not take a lot of risk. The inefficiencies and the times when there's the biggest range in the stocks is usually in the morning. So that's the best time of the day to trade. And then the markets and the stocks always tell you what to do. So this afternoon's market, after we sold off, we kind of got up in the middle of this range. It just kind of went sideways. So that wasn't a high percentage trade. You always need some kind of trending market to consistently make money, right? To have a higher percentage opportunity type environment to make money, better said. So then, of course, at 4 o'clock, the regular market closes and the post-market starts. And that's a very high risk time of day to trade. All right, that's really for advanced traders who really understand news. We have peak earnings season starting next week. Today we had a couple of stocks that posted earnings after the close. Today was the first big major Dow component large cap to post today, and it was Alcoa. It came out and it had about a 10-cent move in the post market. Not that big a deal. There was another stock, an online community college, APOL, that had a $3 range, or $20 stock with a 15% range in its market cap in the post-market in like a half hour. So that was very violent. Very high risk, I know, because I was trading it. All right, so let's go back. So that's, just kind of talking about risk levels and times of trading. Let me take a step back and let me get over to some things that I'd like to talk about that are important topics as they relate to newer traders. Defining risk as it relates to your equity. All right, that's a topic I'd like to talk about with this group. All right, if you are an unproven trader, all right, and you're just learning this business, there's a probation period involved here. All right, and it's anywhere from 1 to 3 months, from 3 months to a year or even longer before you really turn the corner to consistent profitability. So that's something you have to consider when you are entertaining the thought of making this a profession. All right. One thing I guarantee right now, I have about 20 kids right out of college right now, most of them from NYU, that are all starting to trade with me. Like Mike was saying before, he likes to work with people who have never traded before, you know, and I like to do the same. I don't like teaching an old dog a new trick. I like teaching fresh minds because they typically learn from their mistakes and they correct what needs to be correcting, and they don't typically make the same mistakes over and over again. All right. So here in this business, you have at least a 1 to 3 month time period before we really figure out even if this is for you or not. All right. It could take at least 1 to 3 months before you really know if it's for you. And I'll definitely know. That's one thing I guarantee everybody who starts in my group. Within 1 to 3 months, I'll be able to tell by your trades if you have the personality and the discipline for this type of career. You know, and then it could be anywhere from 3 months to a year before you really turn the corner. All right. So you have to think about this like it's a master's degree in equities trading. All right. This is not a get-rich-quick plan where you come in, you know, you watch somebody else, you start trading, and, you know, all of a sudden, you know, you're making, you know, more money that you did at your current job, and you're doing that. You have to have realistic goals. You have to look at this in terms of risk. You have to look at it as more like how much can I lose as opposed to how much can I make. That's the first thing you have to do, because mostly everybody who starts out new is coming in with limited funds. All right? The person who has more expendable funds to put towards this career change opportunity is the person who tends to be more successful. But typically people come in here with somewhere around the neighborhoods of 10,000 to start out with. And 10,000 is a good amount if you're serious about getting involved in this career. All right, that will give you enough staying power to have a properly funded account, to trade stocks with the right amount of equity, and to be able to, you know, support your business until you turn the corner. And what dictates that you turn in the corner is when you get to the point where you can consistently make money on a weekly basis, then a monthly basis, and then a quarterly basis. Once you get to that point where you have 3 months where you're consistent on those bases, a weekly, monthly, and a quarterly, then you have a proven, defined strategy that's working. Then you've obviously have the discipline to make it work. Then you could write your own ticket. All right, that's where the ultimate goal is. Some people do it right away. I have had guys who've turned the corner right away in 3 months. I've had other people that have taken it up to 2 years. It all depends on the individual. All right, so sometimes it depends on the market a little bit, but I'm a firm believer that there's no bad markets. There's only good traders. Back in those early years when I was showing you my resume before, back in the internet boom years between 97 and 2001, there were just as many people blowing up back then as there are now. And people say it all the time. Oh, yeah, I wish I traded then. All you had to do was get long and make money. It's nonsense. Just as many people back then were losing money as there were, you know, people in maybe like the '08 crisis. And the '08 crisis, by the way, the financial crisis, was one of the best years I've had. That was a great market if you were short. If you had a consistently trending, downtrending market, and you had very, very tradable stocks. Financials are very, very tradable. You know, the ranges in the stocks, the liquidity of them, they're just very good, friendly, easy stocks to trade, especially when they get in a trend, either up or down. And back then they were going down. Let me get rid of this real quick. And I don't know why it's doing this. I'm just going to click apply, get rid of that. Defining risk as it relates to your equity. All right, so say you came in with $10,000, right? You registered with our company, with Legend, or with Quasar, who we're currently doing co-registrations with. You took your test, you got yourself Series 56 certified, you funded your account with $10,000, and you started trading, right? A good rule of thumb that I tell everybody is never lose more than 1 to 3% of your total equity, all right? Remember, you got like a 3-month to a year-long trial period before you really figure out, if this thing's going to work for you or not. Within, though, the first 1 or 2 to 3 months, though, we'll know whether or not you have what it takes. I will definitely be able to tell you if you have what it takes or not. All right? And then sometime between that time and a year, you should turn the corner. So if you only have 10,000 up, a good realistic downside risk, and remember, you're always looking at this from downside risk. How much could I lose? All right? You worry about the profits. The profits will take care of themselves once you turn the corner, once you're consistent on that weekly, monthly, quarterly basis. It doesn't matter so much about the day. You're going to have up days, you're going to have down days, but you need to be consistent on a weekly, monthly, and quarterly basis. Once you get to that point, though, that's when you turn the corner. So the key is to keep your initial capital equity that you put up preserved. That's something where I come in, all right? I'm an expert at helping people preserve their capital risk. I've trained so many guys. I've seen so many guys come and go. A couple of statistics on this business, in this industry, all right? There is a 95% failure rate in this, 95%. It's probably even higher, all right? Most people who go out, try and do this with no formal education, not in a group setting, not with using a mentor, having somebody who's watching their P&L all the time, proactively coaching them, proactively talking to them, giving them ideas. And these are all things that I do, by the way, for all my traders. And I have 20 people registered here at this firm that are currently under my membership. And I've only been with this firm for a year. I have about another 20 that are in registration. So I'm looking at I'm a Series 24, which basically means a compliance supervisor, all right? So I'm able to look at a risk monitor is what it means. I had to study for 9 months to get this test so I could look at a risk monitor and see what everybody's either up or down and what their positions are, all right? So I'll be able to help you with managing that 1 to 3% total risk on your equity over the course of the day. So getting back, if you had $10,000 in your capital risk and you're not a proven trader yet, good rule of thumb is 1 to 3% of your total equity you risk on any one given day. So that means on what? On 10,000, that's $150 to $300. All right. So maybe you're risking like $50 to $100. Yes.
How many positions do you have to be in on that 1 to 3%?
Well, if you're a new trader, and the question is how many positions can you have and still be able to keep it 1 to 3%? Well, that's a good question. As a beginner trader, you're going to start out just trading one stock at a time. As you get better, you'll be able to juggle 2 stocks at a time. Okay. As you become more skilled and defined, you'll be able to trade maybe more. Back in the day when the NASDAQ went from 1,500 to 5,000 in 5 years, I had anywhere from 10 to 15 positions on at a given time. And we had a special system on how to identify what was winning, what was losing. Yeah. 1 to 3% on each position. 1 to 3% on your total equity. Total equity. Right. So say you got 2 or 3 positions on, right, and you're down, you only have $10,000 in your membership, and you're trading with, say, $150,000, and you have $150,000 maybe in the market, and things tick down, and all of a sudden you're down 300, then it's probably a good idea for you. I mean, in that position, and this is something I'll teach you in my advanced classes, what you do in that position when you have more than one position on, right, and you're losing money, you pull up in your main box that's linked to your charts, the one that's losing the most money. The other 2 will take care of themselves, right? So you want to babysit the one that's giving you a problem. Get rid of your losers, keep your winners, right? Common mistake that newer traders make is they'll get rid of their winners right away and keep their losers, right? That's a very common mistake with beginning traders, and it's a bad strategy, right? You want to get rid of the idea that it's not working. Get rid of that and stick to what is working and concentrate on what is working.
And what type of time frame are you talking about? Because if you have like 3 positions with 1 to 3%, that's pretty fast.
That's very fast. So maybe if you only have, if you only have 10,000 up and you could only risk $300 in one given day's trading session, you probably shouldn't have 3 positions on. If you do, you better make sure that they're very tradable with tradable ranges and you have the right share size on, that your P&L is not going to have that excessive of a range swing. Right, yeah. Good questions, very good questions. So as a beginner trader, you really want to stay focused on maybe 1 or 2 positions, right? Not lose money, concentrate on sticking with what's working and locking in your profits, all right? But then again, the main thing that we're trying to concentrate when you first started is just learning the semantics of trading, defining your style, and preserving your capital risk contribution. That is the big thing that gets everybody. That's why more people are not in this business, and this is why a lot of people can't hack it. All right, and that's why after 2001, when the NASDAQ went from 5,000 and went all the way to 1650, 1450, I remember those numbers. In 18 months, that's a violent move. That's bigger than the crash in 1929. That's bigger than the crash in That's a violent move. From 5,000 to 1450 in 18 months. I mean, percentage-wise, how big is that? That's massive, right? After that happened, a lot of people, all they knew how to do was trade one style, buy dips, right? Because everything always came back from 97 to 2001. Every time you bought a dip in Amazon and Yahoo, it went back up. JDSU, STLI, the types of names you were trading back then. And that's what happened. A lot of people kept using that style, and they diluted their equity. I saw plenty of people go from seven-figure, multi-seven-figure accounts to back to home living with their parents. No joke. And that's why you want to be in an environment like this one. You want to be around guys, you know, that are consistently profitable, that have made it through these times. You know, that whittled out, and the market, there's no bad markets, there's only bad traders, and it was so true back in those times. So you want to be around people that are consistently profitable, that give you some kind of an edge, all right? The people that are in our group that take courses like at Affinity or, you know, are registered in my rep and are being professionally managed, they have a 50% chance of success, all right? As opposed to the guys who go out and do it on their own. They're definitely close to 95 to 100%. So that's identifying risk as it relates to your equity. That is the secret to this business. You need to be able to get through to the point where you actually know what you're doing and still have equity there. So many people get started in this business, they'll fund an account, right? And say you fund $10,000, that'll get you $150,000 in firm allocated money. It's very easy with $150,000 worth of stock buying capacity to lose a $10,000 capital risk. It's very easy, all right? And that's what happens. A lot of people get into this business. They don't have a defined strategy. They don't have consistent profits. They don't have proper education. They go out and they use that big amount of leveraged size money and they start trading, and before they really know what they're doing, within 2 to 3 months they're out of the business. So don't be that guy, all right? So use good discipline. If you lose more than 1 to 3% of your equity, we review your trades at the end of the day anyway. We review your trades. I review my traders' trades as they're happening. During the day, midday after lunch, at the end of the day, I'm always chatting to my traders, either inside my shop, I'm walking over to their platform, or inside my trading room. Half of my traders are remote and inside our online trading room. So I could click and pull up their platform on my Tachyon trading platform. I could just click on their ID and boom, I have their platform. I could see everything that they did, what they bought, what they sold, what they're up, what they're down on every position. And I know those positions because I traded those stocks all morning. So I know what's going on in those names. So I will be able to instantly tell them, you know, or suggest to them what they did right, what they did wrong, what they need to work on, whether they're trading too big, whether they're trading too big a size in an untradeable name, all right? And that gets into tradability, defining tradability, all right? That's something that a lot of people don't understand. So let's go back to that model. If you have $10,000 and you could only risk $300 in any one given day, all right? So that means maybe you could risk maximum $50 to $100 per play, right? If you make 3 bad plays in a day, 3 red plays, it's maybe not your day. Maybe it's not the day of the market. You're down over $300. You stop trading. That's it. Talk to your mentor. Talk to your coach. Don't get dejected. Keep a journal. Keep notes. And don't make the same mistakes the next day. All right? And it's never the market. It's very rarely the market. It's you not evolving and adjusting and trading with what the market and the stocks are telling you. All right? There's a very, very fine line between the difference between managed risk and gambling. Very, very fine line. All right? So you always have to have good arguments. All right? The more arguments you have, and I'll teach you how to define arguments in this program. The more arguments you have, the higher percentage you have of a successful trade. All right? So say you have, whatever, you know, a $300 range on a $10,000 capital risk contribution. All right? You know, give each position about, you know, $50 to $100. You know, if you have 5,000 up, well, then it's only $50 per trade. And that's fine. So defining tradability, let's get back to this topic. So then if that's your risk parameter, you have to be able to, every time a stock is in play for a reason that you're trading it, you have to run this through your calculator every day. So say for whatever the reason is, say Bank of America, right? Say whatever, Whitney comes out, who's a bank analyst, and she says she likes the banks like she did 3 weeks ago. And then CNBC says something like, we're going to interview her at 3 o'clock today during market hours about what she thinks about the banks. And you pull up Bank of America and it's on its highs, right? And you maybe want to momentum trade it long. You wait for a proper pullback and you get it at just the right spot when it shifts at the right spot and it's showing good relative strength against the market and it's a tradable stock and all these kind of nice arguments are setting up. You have to look at the total range of the stock. So say, for example, like today, Bank of America had a range from 1210, and I know this without looking at a chart, from 1210 to 1190 basically, maybe a little bit more, plus or minus a couple pennies. So Bank of America had a 25-cent range, right? So let's say you have that $10,000 account and you could only risk $300 on one play, or you could only risk, say, $100 on one play, right? If Bank of America, if you use it, and another good rule of thumb that I'll give you for this formula before I ask the question is, a good rule of thumb is to take the total range of a stock, right? And Bank of America today was what? It was 25 cents. The high was 12.15. The low was somewhere around 11.90. So if it had a 25-cent range and you made the worst trade possible, you bought the top and you sold the bottom, right? So your max risk is what on 100 shares? $25, right? You have a 25-cent range on the stock from the top to the bottom. And you bought the top and you sold the bottom. How many shares, if you have a $100 risk on one play, can you play of Bank of America when you first type it up? How many shares, guys? About 300, right? 300 times 25 cents, that's $75, maybe 4, right? So 4, 500, right, very good, all right? So this is something, tradability of a stock. This is something, a formula that goes through my head as soon as I quote a stock. When it's in motion, I see it on my high-low ticker. Some guy calls it out in the room. Somebody chats to me in an online trading room, whatever. That's the first thing I do is I pull up the stock and I see what is the tradability of the stock? What is my max risk in the position, right? What is my max risk in the position, okay? So today I was trading APOL, which had earnings tonight. It went from 21.75 all the way down to 21.40, and the high of the day was 21.85. Right, so the stock had a 40-cent range. So my max risk was maybe I wanted to give it $100. So it was kind of like that. It was about a 40-cent range, and my max risk was $100. My max size on the stock was about 200 shares. Right? Let's take it to the other extreme. People like come in here and they want to start trading, and they see high flyers like Apple. Right? With everything that I just spoke to you guys, let me ask you this question. How much of a capital risk contribution do you have to have in your account to trade Apple if it has a typical daily range of, say, 15 points? Right? And it does. Apple has a typical average daily range of about 15 points. Maybe it's closer to 10. Some days it's 25. Some days it's 5. So let's say it's 15 points. Right? Let's say from the high to the low on Apple is 15 points, right? How much money do you have to have funded in your account to trade 100 shares of Apple computer? 75,000. About 150 grand, about 100 grand, right? So, right, so 15-point range, right? If you trade 100 shares and your max loss then is what? $1,500. 1 to 3%, 1,500, right? It's like 100,000. So how much money do the guys have in their account that are the biggest traders at the firm that are swinging 1, 2, 3, 4,000 shares of Apple, right? You want to sit in a room with guys like that, you got to have a couple of $1 million in your account. So know where you are at all times in this business. All right? So that means that everybody in this room, if you fund 10,000, maybe you could trade what? 10 shares? 20 shares? And it's probably not even really worth it. Right? You're better off trading something that's tradable. So measure tradability of a stock. That's one of the first lessons you need to learn in order to preserve your capital risk, right? And be able to make it through the probation period that we're talking about, which could be anywhere from, 3 months to a year. All right?
What time frame do you define the range then? That range, the high to low?
Well, let's say, you really don't start trading until the first 15 minutes or the half hour of the day, so the range is usually defined by that. Or say you come in the afternoon and you trade it after lunch at like 2 o'clock or 2:30. You have a very well-defined high and a very well-defined low. So you know your max risk that you're taking. So that's a good way to average it. And, I'll tell you, this is like 20 slides of one day of my class. I have a 5-day class that goes on, and this is a 1-week class. All right? I have a 3-week-long class that I'm teaching that I'm in the process of working with Mike putting together. And this is what I had over when I was over at Juggernaut. And this class was subscribed to by probably about 300 to 400 people. And they took it all, I taught it every quarter. And the way we do it is we provide unlimited retakes. This 5-day course, by the way, we're going to do at a very, very low, inexpensive price of $4.99. It's going to be a 5-day course. It's going to be 2 hours a day. All right, and it's going to be all these different topics that I'm going to be going over. Tradability was one of like 15 topics today. All right, so these are all kind of the things that I'm talking about that you get with, being around a group of guys that have been doing this 3 to 5 million shares, bloody blue, day in, day out for 10 plus years. All right, so take advantage. I mean, you cannot buy that kind of education anywhere. So take advantage of those kind of things. And that's the difference between the 95% failure rate and the 50% success rate that we have in our tutelage. And it's not 95%. It really is closer to 100. All right? So I'm kind of all over the place here. This is the one slide I want to wrap it up. We got about 10 minutes left. And I just want to make sure my recording's still going. All right, so these are the first couple of necessary questions that everybody needs to ask, all right, if you're thinking about getting in this business. Okay, do you have the equity staying power? Okay, all right? I'm teaching a lot of students right now, so I'm fine with them having a second job, all right? You either have to be one of two different types of people. Either you have to already be like maybe semi-retired and have enough funds to be able to pay your rent, your, whatever, your education, fund an account, commute to work, food, all those kind of things. You need to be able to carry yourself for that amount of time. You're going out and starting your own business is what you're doing. And by the way, this is a very, very unique business where you could go out and start it with as little as $3,000 to $5,000, all right? You don't have to pay for expensive educational courses that charge up to $5,000 to $10,000. You could just register with me, and you'll have me as a coach, and we'll help you turn the corner. All you have to do is provide your capital risk funding, and I'll help you with the rest. All right? So you need equity staying power. All right? You need to be able to get to that point between 1 to 3 months that I keep talking about, and 3 months to a year or whatever it is that it takes for you to turn the corner. All right? If this was easy and it was get rich quick, everybody would be doing it. And that's kind of what happened from 97 to 2000. People just hit Shift B, and were like monkeys and bought pullbacks. And that's all you had to need to know. Buy a breakout or buy a pullback, and you got paid. If there was a gap down, you bought it. If you came in and we were lock limit down, Greenspan came out and said irrational exuberance the night before, and we locked down 30 or 40 S&P handles, all you had to do was get long, and we filled the gap to the upside until it stopped working, which happened in 2000, 2001. All right? So make sure that you have the equity staying power. All right? You need that. So either have yourself where you have another job, you have discretionary income, whatever you have to do. Don't be the person that comes in here and scrapes together your last 5 or 10 grand, puts it all in a leveraged account, starts trading, and expects to pay his rent, car payment, and all those kind of things within the next 1 to 3 months. Be, sensible, all right? Be smart. Be disciplined, all right? And that's what I talk about here, discipline and an edge, all right? This is not brain surgery here, all right? These are the two most important components in this business, these two items right here. Do you have discipline and do you have an edge? The edge that you get is from whatever, being part of Mike's group, being part of my group, being a part of Affinity Online Trading, being inside our online trading room, being registered with us, being on our trade desk, having a mentor that's watching over you, managing your positions, helping coach you. Those are the kind of things that give you an edge, all right? The other thing is discipline, all right? We're going to teach you what you're doing wrong, all right? You start out small. You trade small until you really learn what you're doing, 100, 200, 300, 500 shares, depending upon the stock and the price and the range and the tradability as we discussed. All right, so discipline, all right? Are you the type of person that could correct your mistakes, all right? Don't keep making the same mistakes over and over and over again, all right? I've been in this 20 years, and that's my biggest downfall. I have flaws in my discipline. I've made the same mistakes, and it sets me back. I'm not really where I should be right now because of that. So that's the best way to have good discipline, in my opinion, is to keep a good, steady journal, all right? And know your limits and stick to them, all right? Everything that we do here, and I'll give you a good example of how discipline breaks down and how it helps people who are like doing retail or going out on their own and how they typically fail because of poor discipline, right? You have a reason why you want to buy a stock, right? It's breaking out, it's into a gap, it got upgraded, it had good earnings, it's trending, it's got relative strength against the market. That's my biggest argument, right? Gap fills, gaps in the morning, and relative strength against the market. Is the market going up? Yes. Is your stock going down and you're short? Yes. That's good relative weakness against the broader market, right? Is the market going down and you're long? Is your stock still going up? Are you making more money long as the market's going from down 50 to 60 to 70 to 100 points? Then you know there's a real buyer in the stock. All right, that's a good argument. All right, as soon as things shift and you're not making money and it's going against you, and you're at that threshold that we talked about, 1 to 3% of your total equity, you need to be doing what? You need to be stopping out. You need to be proactive. You need to be typing orders, having a game plan, knowing what price level to get out. Don't ever be the guy who says, I'm just going to wait and see what it does. That is the fine line between gambling and managed risk, right? Or the guy who says, hey, you know what? I had one of my traders tonight say to me, hey, could I take he was trading it in the post market, and he was down like $10 or $20. And he's like, hey, Tim, could I take this overnight? And I'm like, absolutely effing not. No way. No. Why? Because overnight's going to make it better, right? Think about the level of risk that's involved in that. Anything could happen overnight. We could go to war with Iran. You know, anything could happen. Anything could. A plane could crash into a building. You know, so and that's the fine line. He had an argument for trading AA in the post market. It came out with earnings, whatever. It was trading. It was strong. It was trending up. There was a reason to be involved in AA, right? All that's very good, and he had good, solid reasons to take a managed risk trade. Now, he's down a little bit in it, and he wants to take it overnight. That's a breakdown of discipline, right? Because the arguments aren't there anymore, right? All the arguments that you used to build to enter a position, once they're gone, that's when you cross over from managed risk over to gambling, right? So that's the person who fails. And the person who makes that mistake is the person that will not be around between 3 months to a year's time. All right, that'll be the person that's in our group that's 50% of the failure rate. All right, so many people make that mistake. And that's why a lot of people burn through their money before they really know what they're doing. All right, just because of poor discipline habits. So the most successful people in this business that are consistently profitable, they have good discipline. All right, alternative income, all right, that's a good, we spoke about that. That's something that you need. You either need to be well-funded or you need alternative income or whatever it takes to, you know, successfully take this. You know, like I said, you got to think about this like it's a master's degree. All right, and the reason why I cover all these things, all right, is we're not into, and I'm not into, I don't want a revolving door on my trading desk. I don't. I hate having people come in, kick the tires, see if this is for them, and leave. It's wasting their time. More importantly, it's wasting my time. All right? And I don't want to waste my time. You know, I love giving my time to people and teaching them how to trade. But, you know, if you're not going to apply yourself, you're not going to have the right discipline, you know, then it's really not for you, you know. But if you do have those simple, and I like to think they're simple, those simple qualities, then this is something that's good for you. All right? And if you could make it work, you could write your own ticket and buy your own freedom and change your life, because this is the greatest job. I mean, we have Mike's online trading room where I co-broadcast. We have about 100 people in there every day. All right? About 20 of them are my traders. All right? Half of my guys traded positions that Robert called out this morning. I was busy. We're doing this cutover from Legend over to Quasar, and I was involved with that with my traders. But my traders that were up, I told them to just listen to Rob, and Rob gave them a nice, easy, tradable trade today. Cypress Semiconductor, $9 stock, $10 stock, 70-cent range. All right, think about that. They captured a 70-cent range in a $10 stock today. Do you know how much that is? That's 7%, right? People who invest in swing trade, they'll hold a stock with all kinds of crazy risk for a year to hopefully make something like that, 7%. We made 7% on a stock, on our money, between 9:45 and 10:30 this morning. Right? If anybody wants to look at it when I finish this presentation, I'll pull it up on my trading platform, and I could show you the trades that one of my beginner traders made on Cypress Semi, and he made $200 on the trade. Right? $200 might not seem like a lot of money, but for a beginner trader who consistently makes $200 a day, you know how much that is? That's $40,000, $50,000 a year. All right? I interview kids every single day, right out of college, that have 6 figures in debt for college, and they can't even get a $40,000 or $50,000 job. You know, most of these kids, they're trained, they have masters in finance, because 10 years ago, you were able to come out of college with that kind of degree, walk down Wall Street, and get a 6-figure job. It's gone. It's erased. It's not longer part of the model. You can maybe get 40 to 50% of those kids out of college with a 3.9 cum and a master's could maybe get a $40,000 or $50,000 a year job, right? You know who could get a six-figure job on Wall Street? Or a $500,000 job? You know who could get it? The guy who could pull up a prop report that's already registered from a credible firm like this one, who could show a quarter's worth of earnings of profitable trades. That guy could go work for a hedge fund. That guy will be considered. So, having said all that, any questions? I'm going to wrap it up here. Anybody have anything? That's my rant. I like to talk about these success requirements that I have up here so you could have an idea if this is for you, because I think that's kind of what everybody's doing here. They're just kind of feeling it out to see if this is something that might work for them or not. So, if that's not it, I'm gonna end the recording. Any questions, guys? Nothing? If you guys want to come, why don't we wrap it up? Everybody come over here, and I'm going to stop the recording, and thank you everybody out there in the recording land who attended. If you want any information on this class, go to email tim@affinitytrading.com if you'd like more information on our proprietary scholarship program. All right, and I'm going to wrap it up. You guys want